Welcome back. Time to get technical. And there's never been a bad time to talk about Bollinger Bands and head and shoulders patterns, according to me. But this week is a particularly good one after Tuesday's sell-off. Our next guest says stocks and credit have bottomed and the dollar, crude oil, and gasoline have peaked. Let's dive into the charts with Rich Ross, Evercore ISI Sr. Managing Director for Technical Analysis. Rich, great to have you here today. Let's start with the indices. The Kahuna S&P 500 had a massive 4% down day earlier in the week. So far has failed to take out the lows of a couple weeks ago. But how precarious is this, and what are the levels you're watching here?
Yeah, look, I think it is still a precarious situation, to use your term, but it's always precarious at the end of a bear market, a market that's trying to transition from bearish to bullish, as it were. And our call and our charts continue to suggest that that's exactly what's going on here, that the S&P is forming a bottom. Keep in mind, we've been spoiled technically in recent years, that we've had these V-bottom reversals after sharp declines, as we saw in February, March 2020, with the pandemic plunge, as it were, and again in 2018 with that Powell rookie mistake where we just sort of stuck our cleat in the turf and pivoted back in the other direction. This is more of a traditional bottom in the absence of that proverbial Fed put, but it's a bottom to be sure.
All right. And just moving on to, I want to take a look at HYG, the credit market. This is an ETF that tracks high yield. I was watching this with particular interest in that rally that we had in the first part of August. Then we saw a big decline. It was one of the leaders in that decline, one of the laggards in that rise. How important is this chart to you? And can you break down some of the technicals here?
Yeah, I think it's extremely important. It's a great point. And I think when people think back, they have the muscle memory of 2008 and prior crises. I mean, credit is at the heart of those major market drawdowns. Not that 25% off the top isn't a major drawdown, but that's more consistent with a traditional bear market. In order to get a bigger crisis type decline in the mid 30s, perhaps even 40+% as we saw in the financial crisis, typically an unwind in credit would be one of those key catalysts. So to create a double bottom here in the HYG or the JNK, some of those very well followed high yield ETFs is critical. And I think that's exactly what's happening. So again, I believe the HYG is a double bottom, the JNK is a double bottom. And take it a step further, whether we look at munis or preferreds, you're talking about a triple bottom in things like the MUB municipal bond ETF. So I do think it's a key cog in that bullish call. But again, my call is that we are bottoming on the credit side.
All right, noted here. And I want to keep it with credit, but specifically the sovereigns. And we got the 10-year yield, 3.5%, a huge, big technical level, potentially a double top here. I don't know, because the federal funds projected terminal rate is somewhere about a percentage point higher. That's 100 basis points. What are you reading in the chart of the 10-year right now?
Yeah, look, it's been one of the key sources of concerns this year, clearly, as those rising rates have coincided with falling stocks and risk appetite more broadly. And to your point, with that terminal rate still in excess of where we are today on those 2-year yields around 386, with that terminal rate, importantly, you are getting in and around those levels where we see those Fed projections, 350, a key technical line in the sand in terms of 10-year nominal yields here in the U.S. And of course, our counterparts over in Europe also testing key levels in Italy, Germany, France. Importantly, we haven't taken out those levels with the exception of the UK, where we see gilts push out to new highs in terms of yield, new lows in price. But if we're able to hold in and around these levels, I think it's consistent with the idea that this band of risk aversion can come back together rather than snap and fall apart.
And interesting for me to note in your charts that you sent over to us today, the 10-year Italian yield, quote, "You knew, Marcus Aurelius," something uttered by Russell Crowe in the Ridley Scott movie Gladiator. So I do appreciate that. Want to move on, stick with the 10-year, talk about break-evens and the real yield. Now, the real yield, you talked about it briefly, tracks more of what the Federal Reserve is doing. And the real yield is part of the overall 10-year yield. So are the break-evens, which track inflation. And the real yield, what the Federal Reserve is doing, has screamed higher, and that has been hurting tech. So can you break down this chart for us and show us what this might portend for some of these hard-hit equity sectors?
Yeah, it's a great point. And as you alluded to, what we've actually seen is inflation expectations, as illustrated by those inflation break-evens, have been plunging. So the market-based expectation of inflation, whether it's 1 year out, 5 years out, 10 years out, it is falling off a cliff, even as we saw the hot CPI report that preceded the 4% plunge in the indices. Now, that said, your nominal yields have been pushing higher. The difference between the two, the inflation expectations and those nominal yields, that's your real yield. And that's been moving up higher real yields, to keep it simple, are the enemy of the longer duration asset, the more highly valued asset that in particular we find on the technology, on the growth side, and what drives the indices, those big tech and growth stocks. So round and round we go. We need those real yields to back off. You're up around 1% on the 10-year real. Keep in mind, the high, the peak that we saw back in 2018 came in and around 115. So much like nominal yields themselves bumping up around those highs at 350, those real yields also testing really important resistance up around 115. If we can back off and get some relief there, then I think it sets the stage for some of those longer duration assets across technology and growth more broadly to move higher and start to provide support for this market rather than an anchor.
And arguably, some of those mega caps are some of those longer duration stocks as well. Apple, kind of its own asset class, but I want to talk to you about that before we leave. Also, if you want to throw in any of the other mega caps in there. The iPhone 14, I believe it is, those preliminary sales going to be huge here, and the most closely watched stock in the world. What are you seeing in the charts?
Yeah, look, I think importantly, Apple, 7% of the S&P clearly makes it important by math alone. And it's been a great stock this year in terms of both relative and absolute performance. So when 7% of the S&P is in a strong position, both relatively and absolutely, I think it provides a nice stability for the market itself. Maybe stability isn't the right word in the throes of a bear market here. But again, I guess my key point here is there's 7% of the S&P that I don't worry about when I go to bed each night, and that's Apple Computer. And when that 150 key line in the sand there, again, I think we do hold that 150 and Apple gets back on its horse. I think Apple pushes out to a new high in Q1 next year. And if 7% of the S&P can make a new all-time high, both relatively and absolutely in a bear market, that's a pretty good starting point for a bearish to bullish reversal in the broad market.
Hey, Apple new high Q1 next year. I think a lot of investors would take that, and they'd like to know what the 93% of stocks that you worry about or potentially worry about late at night are. We're going to have you back here. Thank you to Rich Ross, Evercore ISI Senior Managing Director for Technical Analysis.